Right. I think we're all ready to get started.
Well, hello everyone. My name is Marguerita Cheng. You can call me Rita, and I'm a certified financial planner based here in the DMV. In fact, I always say I'm MCMC, the CFP from the DMV. I'm based in Maryland, and we are here to learn about how we can secure our future with a particular focus on business retirement and long-term financial planning. Uh, I am here with my colleague, John Clark. I'll be doing the first half and then I'm going to turn it over to him. Next slide, please. Thank you so much for tuning in with us today. I would be remiss if I did not acknowledge. I apologize if I don't sound too good. I'm a little bit hoarse, but I did get my voice back, and I wouldn't want to miss this for anything because long-term financial well-being is so important. Today in my section, I'm going to be kicking off the intro, understanding retirement needs, right? Because I know we want to plan for retirement. And then we're going to discuss retirement plan options for business owners. There's a lot of options, and they may be right for certain business owners in certain situations. Next slide, please. Introduction. So, uh, you can continue. I always tell people that it's so important to plan for retirement. There's no financial aid in retirement. Your kids can get merit, financial aid, need-based, interest-based, etc. So according to a survey um, by RBC Wealth Management, 49% of owners do not have a will, and 22% have not started any formal wealth transfer. It's never too early to start, and it's also never too late to start. 34% of small business owners have no retirement plan outside of their company, while 40% rely on selling their business to fund retirement. Now, I tell people there's nothing wrong with relying on your business. However, in our presentation today, we are going to learn how you can build wealth outside of your business, save money in taxes, and do right by your employees. It's a trifecta. Interestingly, only 20 to 30% of listed businesses end up selling. That means that relying just on selling your business may not be as solid as it seems. Next slide, please. So to enjoy a desirable retirement, it's important that business owners, entrepreneurs start taking advantage of tax-deferred retirement accounts. As I mentioned, I have full faith and confidence in everybody's ability to run a successful business, but it does make sense to start to build wealth outside of that for diversification, to save money in taxes, as well as to help with employee retention. So let's jump into it, and we're going to share some options. So next slide, please. So understanding your retirement needs. So I know you're all excited to plan, but it's important for you to think about what you desire in retirement. So sometimes people actually end up spending more in retirement because maybe they didn't have as much time when they were building the business to travel and do things. Step two, categorize your expenses. You want to organize your expenses by essential expenses. This is what I tell people, core expenses. And your wants, it says discretionary, but think about lifestyle. So I'm just going to give you a little bit of wholesome humor. I know I'm the first to admit I probably spend way too much money on coffee and matcha. But for me, that's not like discretionary, that's lifestyle. When I travel, I like to go to a new city and check out the matcha scene or the coffee scene. So it's really important that we understand there's core and essential expenses as well as lifestyle and variable. So what's discretionary for one person may be essential for someone else. Account for inflation. So inflation is stealth. It can really sneak up on you, which ties into the next step. Next slide, please. Healthcare cost. So who would have ever thought that longevity, living on this fine earth for a long time, is a risk? I wouldn't say it's a risk per se, but it's important for us to take into consideration inflation as well as healthcare costs. Particular focus on how healthcare costs are inflating at a faster rate than other goods and services. Preparing for emergencies, making sure that you have liquid reserves, as well as the appropriate insurance and risk management. Step 6. The reason why I had you go all through these 5 steps before we get to 6 is it'll help you determine how much you may need to save for retirement on an annual basis, because you want to kind of have a number, an idea. You estimate that. Step 7, then of course, next slide, please. Step 8, once you know what you need, then you break it down. And this is what I said, some people I know might spend more in retirement, and that is okay. It's just important to know where you are and then know where you want to be. And if there's a gap, the best place to start is today. So we're going to start with some of the options we have available. So we talked about the steps that you need to take there, but here are some pitfalls to avoid. It is true that some people overestimate the growth of their investments. They also may underestimate longevity risk. True story, I had a client once, she said, you know what, Rita, I see that financial plan that you developed, but you know what, can you just have me die in the plan at 73? I don't know if I'm going to live to my 90s. Some people underestimate how long they're going to be on this fine earth. Ignoring healthcare costs or ignoring inflation as it pertains to healthcare costs. Those are really, really important. And another pitfall is relying totally on business sales. We don't want to be negative or be Scrooge or Grinch, but it's really important that you have other ways to reach your retirement goal and starting late. Even if you haven't done anything, it is never too late. Just think about, the more you wait, the more you're going to need to save for the future. So this portion of our presentation, I'm going to talk about the 5 retirement plan options. So the first one is, I know you've heard of this one before. This is the traditional deductible IRA. An IRA basically stands for individual retirement account. So a traditional IRA is a tax advantage account where you can contribute to this account on a pre-tax basis. Now, in certain situations, it will be tax deductible. It may not be in every situation, so it's really important that you're mindful and you revisit this every year, because maybe what you did in the past served you well then, but the reality is tax laws change. And then when you take the money out, you only pay taxes upon distribution. So tax deferred just means you don't pay taxes while it's growing. Now, these are the limits for 2026. $7,500 if you're younger than 50 years, and $8,600 if you're older than 50. Now, what's interesting is I know we are still in 2025, and it is December 2025. You still have until April 2026 to contribute for tax year 2025. But I wanted to put the limits in here for the upcoming year. Next slide, please. Now, with IRAs, you, if appropriate, and you do save to an IRA while you have accumulated money along the way, you don't pay taxes on the growth. However, once you reach 73, it used to be 70 and a half, and then the age has increased to 71, 72, now 73, you are required to take RMD, required minimum distributions. Now that's when you're required to take money out, but you can start taking money out as early as 59 and a half. You'll have access to stocks, mutual funds, index funds, ETFs, exchange traded funds, ETFs. I don't want to use acronyms without explaining what they are. There's also self-directed options where you can invest in alternative investments like cryptocurrency, commodities, and real estate. So next option we have, and I'll make sure, that we get into all the details of the plans and we can talk about specific guidelines with regards to income and what's deductible and what's not. That's why I said even though you might not have access to a retirement plan, if you start to earn too much as an individual or as a household, it may not be deductible. So it may not be the best option for you. Option two that we're going to be coming to. Next slide, please. The Roth IRA. The Roth IRA is also tax advantage. Unlike the traditional, you don't receive a tax benefit for contributing to Roth. However, while your Roth is growing, it is growing on a tax-free basis, and provided you meet certain criteria, you can withdraw tax-free. Now, for tax year 2026, you can contribute $7,500 if you're less than 50, $86 if you're over 50. Now, remember, just like the deadline for the traditional IRA, one can contribute to a Roth IRA for tax year 2025 up until the tax filing deadline. Next slide, please. So the benefit to a Roth IRA is the required minimum distributions do not apply. Roth IRA is very powerful. I know we have a particular focus on business owners, but many of you business owners might have children. I have 3 children. And I will tell you, I had my 15-year-old open. Now she's 20, but I had her open a Roth IRA when she was 15 from her earnings as a water safety instructor and lifeguard. The benefit to a Roth IRA is this money does grow tax-free, and it is a little bit more flexible than a traditional in the fact that you don't necessarily have to wait till 59 and a half to get your money. Now you do, there are restrictions with the growth, but I tell people Roth IRA is very, very powerful. A little bit more about the Roth on the next slide. So just like the traditional, you can invest in stocks, bonds, mutual funds, exchange traded funds. If you have a self-directed option, you can explore alternative assets. Now, I told you I had like my daughter open one when she was 15. Of course, in this situation, I did not have her use alternative assets. We just started with mutual funds. So eligibility for a Roth, it's important to check this. Let's just say you put money in a Roth and you realized, oh my goodness, I made too much money. You just need to make sure that you remove the money. And these, you need to make sure you remove it before the tax filing deadline. And these numbers, these limits, these ranges go up every year. So next slide, please. SEP IRA. So SEP IRA is basically a bridge between a traditional IRA and a 401k. And John is going to spend a lot of time talking about 401ks. SEP IRA, they are the contributions to SEP IRA are made on a pre-tax basis. And what I tell people is this is what I call the procrastinator's retirement plan. Listen, if my clients procrastinate, I still love them. I'm still going to help them. But just to put this in perspective, remember how I said the deadline to fund an IRA and a Roth IRA is the tax filing deadline. If someone files an extension, they could, I tell people, please don't do this to me. They could technically open and fund a Roth up until October following the tax filing deadline. That's what I mean by the procrastinator's retirement plan. So let's learn a little bit about the SEP on the next slide. SEP IRA, these are the contribution limits for 2026. Lesser of your compensation or 20% of the net income and $72,000. The maximum compensation that can be used for purposes of this calculation is $330,000. So the 330 number will go up each year, which means that that number that you see, 72,000, will also go up. So next slide, please. Because this is pre-tax, requirement distributions do apply at age 73. And of course, it's designed for retirement, so you can't access it till 59 and a half, but there are some exceptions. So next slide, please. Once again, you have flexibility with how you want to invest. Traditional SEP IRA, meaning just as opposed to self-directed, you can do stocks, bonds, mutual funds, index funds, exchange traded funds, ETFs. Next slide, please. Now, this is what is super cool. I'm telling you, I'm so excited about this because I talk to a lot of journalists. And when I tell them this, like, wait, yes, provided you meet the income guidelines as a solopreneur, you can do a SEP IRA and a Roth IRA. One will allow you to save money today. That's a SEP. And one will allow you to save money in the future. When I say save money, I'm talking about saving money in taxes. Now, this is what's interesting. If you have employees, the percentage you do for yourself for the SEP has to be the same as the employees. And there's like certain requirements. To be eligible, the employee must be at least 21 and have worked for you for 3 of the past 5 years. So this is a percentage. And I did have a client. I helped her open a SEP, but her business started to grow. And it's not that the SEP is bad. When she starts to have employees, we don't want to fund that plan. It might not be in her best interest because then she has to give them the same percentage as herself. Next slide, please. So for that business owner, we had her do a simple IRA for the following tax year. And simple IRA is an acronym for a savings incentive match plan for employees. Thus, the name simple. It is a tax advantaged account where you can contribute pre-tax funds. So there's a pre-tax, you save money today, earnings grow tax-free or basically tax deferred. And the contribution limits are 17,000 if you're less than 50, 21,000 if you're over 50. And then on the next slide, we're going to see something more. RMDs apply. And there's a 10% penalty, just like with many other funds, retirement accounts, that if you take the money. And an additional penalty, I need to disclose, does apply if the account is not 2 years old. So you can continue. And once again, we talked about how you can invest in stocks, bonds, index funds, mutual funds, exchange traded funds, ETFs. There's also self-directed options. So you can continue. And this is what is interesting. So John is going to talk all about 401ks. Sometimes someone may have outgrown the SEP IRA because they don't want to contribute the same percentage to their employees as themselves. If that's the case, they may want to look at a simple IRA or 401k. What makes the simple IRA simple is you can implement this plan if you don't have more than 100 employees. Another thing that makes it simple is you can contribute 2% of their compensation and match, or you can do 3% of their compensation. And what makes it simple is there's not those matches that you give people. You don't have to do like the compliance testing and so forth. So it's a little bit more straightforward, and that is true. The contribution amounts aren't as high as a 401k. And so as we wind down for our last one, meaning before I turn it over to learn about 401ks, let's see our last play. Solo K. So solo K you may have heard the term individual K or single K. That is a 401k for a one participant business owner, a solopreneur, and their spouse. So only if the spouse of such business owners can contribute to the 401k. So the solo K does have a traditional 401k option as well as a Roth 401k option. So in other words, you can contribute on a pre-tax basis and a post-tax basis. And what's super cool, I have to say, it is super cool about the Roth 401k option or the Roth option within the single K is there are no income restrictions for that. So we can continue. And there's a lot about limits, meaning, you can contribute quite a bit, particularly if you have a spouse that works in the business as well. So those are the contribution limits. And then we will continue. Distributions, once again, when there's pre-tax, there's going to be requirement of distributions. But for the post-tax portion, there will be no required minimum distributions, provided the account is at least 5 years old. There is like more flexibility again. And as is what I always tell people, it's so important to take the time to understand what it is that you're trying to accomplish, both for yourself and your employees, before you determine what plan you're going to consider. Next slide, please. And this is more information about this solo 401k and the spouse. It can really allow you to contribute a lot. And right before I transition to John, I just wanted to say that provided somebody meets the income guidelines, they can have a SEP IRA and a Roth IRA. They can also do a single K with the Roth option. They can also have a Roth IRA on the outside if they meet the income guidelines. So there's an opportunity for people to save for retirement and have tax diversification. Continue. And it's important for you to separate your finances, like don't commingle. And we're going to talk about this later as you plan for irregular income because it can be feast and famine. Continue. Make sure that you have the appropriate insurance. You know, insurance is there to mitigate against risk. Have those liquid reserves. And if it's not appropriate for you to think about saving on a monthly basis, designate an annual goal. And then, of course, it goes without saying, you want to pay yourself first, whatever that is. So, we talked about these accounts. I know it says 7, but it might more be like 5 because those are the post-tax, the pre-tax. And then, of course, talk to a financial advisor, consultant to help you determine what's appropriate for you. And so now we are going to learn all about maximizing retirement benefits for small business owners and entrepreneurs. And John will take over and present this section of our presentation.
Great. Thank you, Rita. And thanks everyone for your time here this afternoon. Again, I'm John Clark. I'm with the Sentinel Group, and we are what's referred to as a independent record keeper and third-party administrator. So to simplify that terminology a bit, my firm here, we handle all of the operations and compliance work for qualified and non-qualified retirement. So today, just want to run through, spend the next 20 minutes or so talking about some of the protections that come along with a qualified retirement plan. We'll talk about the flexibility in terms of eligibility, eligible compensation. Rita talked a lot about traditional IRAs, Roth IRAs, simple SEPs. It's a little more flexibility with a traditional 401k profit sharing plan. So I'm going to get into the details there. We'll talk about the employee and employer contribution types that are available. In some cases, we can do a lot more for you as the business owner with a traditional 401k profit sharing plan, for example. We'll get a little bit into the weeds on some advanced planning strategies. We'll talk about the after-tax or Roth component, and then I'll wrap up with cash balance and non-qualified retirement plans, which may or may not make sense for some of us on this call here this afternoon. But we'll kind of run through the options, and what we'll do is we'll save some time at the end for any questions that do come up. So feel free to keep those the end of the conversation here. So let me see here. So just starting with the basics of a qualified retirement plan. And when I think about a qualified retirement plan, let's think about our traditional 401k plan. So first and foremost, when you make the decision to sponsor a retirement plan, you're working with a record keeper like myself, a third-party administrator, and there's also what's called a custodian. Now, my firm here, we do all the operations and compliance work. What we don't do is we don't actually hold all of the contributions here at Sentinel. We partner with custodians like Fidelity, Charles Schwab, those folks who are partners, and they act as a custodian. And what that means is they open up a trust account for the 401k plan where all of the assets are commingled and really safeguarded. And what I mean by safeguarded, I mean in the event of bankruptcy, for example, all of the assets in a qualified plan like a 401k are protected from creditors, both employee and employer contributions. That's going to be the big difference with a qualified retirement plan versus a non-qualified, which I'll touch on. But all of the assets inside a qualified retirement plan are protected from creditors. There are tax deduction opportunities for both you as an individual and for the business sponsoring the plan. And we'll talk about the employee and employer contributions. Over the last few years, the government is really trying their best to get employees or participants into retirement plans, helping them save for their retirement. And what they've done is they've passed some regulations, specifically with Secure Act 2.0, to really incentivize business owners to create retirement plans for their employees if they have them. I'll touch on the tax credits a little bit later on. But just like any other employee benefit that you may offer to your employees or to your staff, we think about the 401k plan as just an extension of the employee benefit offering. So a lot of what I do is I work closely with small business owners. I work very closely with financial advisors and of course the tax accountants, right? As collectively, we do a lot of consulting up front to make sure that we are designing a retirement plan that is in the best interest of the organization and the employees. And again, we consider the 401k as an extension of the employee benefit offering. What we're trying to do here is help small business owners not only attract talent, but keep those employees at the company. So it's an extension of the employee benefit package. Now, I'm not going to get too far into the weeds here this afternoon, but when I'm consulting with small business owners, there's a lot of discovery that happens up front. I need to understand what type of business you have, whether it's a S Corp or maybe it's a partnership, maybe it's a C Corp, the type of entity, and specifically how you're taxed is really going to determine what type of compensation that you need as a business owner to participate into the plan. Again, not going to get too far into the weeds, but for example, if you're an S Corp or taxed as an S Corp, you can only consider W-2 compensation. If you're a partnership, we can consider things like K-1. And this is where a lot of the consulting up front that I do um, also considers the accountant who I may need to consult with in terms of increasing the business owner's W-2, for example. If you're a business owner that has no employees, well, you have a lot more flexibility. If you're someone who does have employees, um, well, there's a lot more advanced planning that goes into designing the plan because we need to consider not only yourself and maybe your partners, but we also need to consider the staff. Again, that's a lot of the consulting that happens up front. We also can get very creative with a 401k plan and really customize things like eligibility. Who's eligible to participate in a plan? When are they going to become eligible, my new hires? Once they meet eligibility, when are they going to enter the plan? The government says the most strict you can be is your employees need to be age 21. They need to work for you for 1 year, and they need to work 1,000 hours during the year to become eligible. Business owners can always scale that requirement back to age 18, for example. Maybe they only need to work for you for 3 months, maybe 6 months. Once they become eligible, maybe they enter immediately, maybe they enter monthly, maybe they enter quarterly or semi-annual. You have a lot of flexibility when it comes to designing a retirement plan for you and your employees, um, especially when it comes to the employer contributions, which I'm going to touch on here in just a little bit. Rita did a great job articulating the contribution limits for a solo K or uni K or owner only 401k plan. Those same limits will apply in a traditional 401k. So what I've done here is I'm showing you the limits here for 2026. It's already December. I can't believe it's almost January. What you'll see here in blue is that same 24,500 limit that Rita had presented for a solo K. Every taxpayer, every individual has the same limit in 2026. It's going to be 24,500. That's the amount that you can contribute out of your paycheck as an individual. You could do that pre-tax. You could do that Roth. You could do a combination of the two, but everyone is limited to 24,500 while you're under 50 years old. And I want to point out here, it doesn't matter if you participate in one 401k plan, two 401k plans, or three 401k plans with different employers. Everyone is aggregated at that 24,500 limit across all plans that you participate in. Now, if you're 50 or older in 2026, they're going to let you do an additional $8,000 catch-up contribution, which you'll see highlighted here in black. Okay, so if you're 50 or older, you can do 24,500 plus an additional 8,000. And to make this a little bit more complicated, if you happen to be between 60 and 63, the government's going to let you do a little bit more with what I call a super catch-up contribution. They're going to take that 8,000 and increase it to $11,250 catch up for 2026. Okay. Now, as an individual in a 401k profit sharing plan, I just described the limits of how much you can actually contribute out of your own paycheck. The rules are written so that you can actually get up to 72,000 a year if you're under 50. That goes up to 80,000 if you're 50 or older, and it goes up a couple thousand more, up to 83,250 if you're between 60 and 63. So how do we get you from 24,500 to 72,000 if you're under 50? We fund that difference here in green with an employer contribution, 47.5 if you're under 50. An employer contribution could be a matching contribution from the business. It could be a non-elective contribution. Most of the time, it's going to be a combination of one of those two components plus a profit sharing contribution. And then this is exactly what I do with all of my clients is I do a lot of this consulting, a lot of these funding illustrations up front to show a business owner what they can do. But just know that gap to get you to the max will be funded from the business. And we'll talk about the tax deduction for the company here in just a little bit. Now, when we're considering putting together a retirement plan for a business owner and their staff, the employees, we must consider non-discrimination testing. So you heard me say I handle as a third-party administrator, I do all the compliance work for retirement plans. A lot of that compliance work involves an annual tax filing for the plan. It involves very much non-discrimination testing, which you see here. If you're a business owner with no employees, you have a lot more flexibility. You don't need to worry about non-discrimination testing. But if you do have employees, this is something you need to be mindful of. So I'm just going to go very high level. I'm not going to put everyone to sleep here this afternoon. But two very important tests that come into play with a 401k plan are your ADP test and your top heavy test. And when you're working with a third party administrator like Sentinel, what we do and what any third party administrator is going to do is we're going to separate the population in the 401k into two groups, your highly compensated group and your non-highly compensated group. To keep it simple, highly compensated will be any owners and anyone who makes over 150,000, we'll say. The non-highly compensated group is everyone else, the employees who are non-owners making under 150. Now, at the end of the year, we look at how much all of the highly compensated employees contributed, and we back into an average percentage across that group. We do the same thing with the non-highly compensated group. We determine an average percentage that they contributed for the year. And the rules are written so that the highly compensated group can only contribute about 2% more on average than the non-highly compensated group. Okay. Now, when I'm working with the business owner, a lot of the times they're looking to maximize their contributions for the year. So they're going to get to 24.5. They may do the catch up if they're over 50. But the highly compensated group, they're looking at maximizing their deferrals. Whereas the non-highly compensated group, may not be contributing. Some of them may not contribute at all. Some of them may not contribute more than just a few percent. But a lot of times that average we get to at the end of the year is out of line with that 2% swing. So what happens is the ADP test fails. My company then takes money out of the 401k plan and sends it back to the highly compensated employees to bring the ratio back in line. And when a business owner is making 401k deferrals throughout the year, and then at the end of the year gets a refund check back for the money they contributed, they're not going to be too happy about that. So we do have a fix for that, and I'll get into that here shortly. But another test that is important is what's called a top-heavy test. And that simply looks at the balances in the plan as of January 1st. And it says the key employees, and again, very high level, owners, officers, they can't hold more than 60% of the assets in the plan. So again, getting back to my prior example, the highly compensated, the owners, they want to put away as much as they can. The times they're going to have more than 60% of the total balance. So what happens is this test fails, and now I got to go back to the business owner and tell them, hey, now you have to give everyone in the clan 3% of their annual salary to fix this failure. Again, just like refund checks, business owners don't want to be told that they have to actually come up with another 3% of everyone's salary at the end of the year. We want to avoid these types of conversations. So what I've typically done over the last 15 years is typically designing my retirement plans for my business owners who have employees with a safe harbor contribution. Now, a safe harbor contribution, first and foremost, is going to be funded by the business. So this is an employer contribution. Employer contributions, just like any expenses that you pay as a business owner for the retirement plan, those are tax deductible. Again, this is where coordinating with the accountant is super important. So, as a business owner, you can choose to fund. Most of us may be familiar with a basic 4% match. My employee contributes, I'm going to reward them with a contribution. Okay. A total of a 4% match. Very common. There's different flavors of it, but we'll say 4% is pretty traditional. A business owner may say, you know what? Instead of matching my employees, I'm just going to give everyone 3% of their annual salary. It might be a good idea if you know your employees are all going to take advantage of the match. You can hedge your bet, fund 3% as opposed to 4. I like the 3% non-elective safe harbor if I'm designing a profit sharing plan for the business owner, because that 3% is going to pair well with the profit sharing contribution. Again, I don't want to get too far into the weeds on the testing and all the everything that happens behind the scenes. But again, if I'm working with a business owner who wants to do profit sharing, we're going to have them fund a 3% non-elective safe harbor as opposed to the match. But the nice part is you're going to get a tax deduction for these employer safe harbor contribution. It's also going to eliminate any of those testing consequences that I described. So we don't have to worry about how much everyone's contributing. I don't need to worry about the account balances because my plan is safe harbor. Okay. Now, we get business owners up to 72,000, 80,000 if they're over 50, maybe 83.5 or 83,250 if they're 60 to 63. How do we get them all the way to those limits? Well, it's your 24/5 deferral, your catch up if applicable, the safe harbor contribution. But how do we close that gap? We do that with a profit sharing contribution. So just like safe harbor, profit sharing is funded by the business. The nice part about safe harbor is the nice part about profit sharing is that it's discretionary year to year. When you decide to be a safe harbor plan, you are locked into either a match or a 3% contribution each year. That's stated at the beginning of the year. You're going to lock into that. Profit sharing, on the other hand, is something that you would decide to do at the end of the year once you saw how the business operated throughout the year. So, for example, let's say my business is profitable. I'm making a lot of money. I'm paying a lot of taxes at the end of the year. I work with business owners to eliminate or reduce that tax bill, dump that money into a 401k profit sharing plan where they're going to cut their tax bill. They're going to get that money into a qualified plan. And with a profit sharing strategy, we have three different flavors. One being prorated. It's kind of like a SEP where everyone gets the same percentage. Not a lot of flexibility. Everyone gets the same percent. Integrated is going to be a little bit different in the sense that it looks at strictly compensation for everyone. And we're going to look at how much everyone earned up to the Social Security wage base. Everyone gets the same percentage. And then those who earned over the wage base, they're going to get a higher percentage on the excess amount that they earned. So a little bit more flexibility with integrated. But what's most popular, what I use with probably 95% of my clients, is what's called new comparability profit sharing. This here is for business owners, again, who want to maximize their contributions into the profit sharing plan each year. It's going to give them the greatest flexibility. What I mean by that is, let's say at the end of the year, the business was doing really well. We have money, we want to put it into the profit sharing plan as opposed to paying it all in taxes. We can give the majority of the profit sharing to the business owner and any key employees with a minimum contribution to the staff. You can't just give everything to the owners. You have to give a little bit to your staff. Again, if you don't have any employees and you're owner only, you have a lot of flexibility. You can kind of give it all to yourself, so to speak. But when you have employees, you can't discriminate. We have to give them a little bit. That's why we give them the safe harbor. We give them a little bit of profit sharing. But my goal here is to give the majority to the owners, but they can be more generous and give more to their staff. But there's a lot more flexibility with new comparability. We also get into when we're thinking about profit sharing, and maybe this might make sense for your business. Profit sharing works really well when, as the owner, you're older than your staff for the most part, and you make more than your staff. So if you're thinking, am I a good profit sharing candidate? Are you older? than your employees? Do you make more than your employees? If that's true, the older you are, the more that you make, profit sharing is going to be a good strategy to consider. Also, within a 401k plan, I mentioned pre-tax and Roth deferrals subject to the limit. We also can do things like convert pre-tax dollars to Roth after tax inside a 401k. So you may have safe harbor contributions that you're getting as an individual in a plan. You may get profit sharing. Those are all pre-tax that you're going to be taxed on down the road. But during the life of the plan, you could decide, working with your accountant, that you want to convert money to after tax now, so gross tax free. You can do that in a 401k plan. If you're a business owner with no employees, you may want to take advantage of after tax contributions, which are above and beyond Roth. It's a separate after tax source within the plan, but you can fund a lot more after tax if you're a business owner with no employees. If you may have seen, every year I get a lot of clients coming to me about mega backdoor Roth strategies. Does this work for my 401k plan? If you're a business owner with employees, mega backdoor Roth probably isn't going to work. And it's because of a lot of the testing that goes on behind the scenes. But if you're a business owner with no employees, mega backdoor Roth for tax contributions, that may be a good strategy to consider because you don't have any employees that have to worry about non-discrimination testing. Paid group is a strategy that we can use as a third-party administrator to help pass non-discrimination testing. Again, I'm always looking at designing a safe harbor plan, so I don't have to worry about any of those testing implications. Now, I mentioned profit sharing plans. We can get business owners up to 72,000, maybe 80, maybe a little bit more, depending upon your age. When I'm working with a business owner whose business is doing very well, steady, year over year doing very well, right? 72,000, 80 grand a year, that may not be enough for them. We may layer on what's called a cash balance plan, which looks and feels sort of like a traditional defined benefit plan. But think about a cash balance plan as a profit sharing plan on steroids. For those owners who are fully maxing out their profit sharing and they want to do more, we'll talk to them about a cash balance plan where, depending upon their age, they can do a lot more inside that plan. And I'll show you here shortly. Tax deduction, again, employer contribution, safe harbor, profit sharing, any fees that you pay for a plan, those are all deductible expenses for the business. So again, instead of paying taxes on all this money the business is making, let's look at putting into a 401k where we can get some deductions. Here's where I wanted to show you kind of Rita did a good job of showing the limits. I want to reinforce those here. I have some age brackets broken out here to kind of show you, from 30 to 60 to 70, what you can do in a 401k only. Here's our 24/5. It works up to 32/5 once I hit 50. Then it gets up to 35/750 once I hit 60 to 63. We can layer on the profit sharing to get them up to 72, 80, 83,250. And then here with the cash balance, if any of you out there are saying, hey, my business is doing really well, there's a lot of cash. Hey, let's look at a cash balance plan. So as you get older, these plans work better, both profit sharing and cash balance. 60 to 63, they could put away almost 350,000 a year inside a cash balance plan. So between a profit sharing and a cash balance, as you get older, you'll see from 30 to 34, it's a couple 100,000. But really, you can almost get up to 500,000 as you get closer to retirement. So cash balance is a good strategy to consider if you have good cash flow year over year. Uh, those plans are not unlike profit sharing where it's optional year to year. Cash balance, you're going to be locked into a 3 to 5 year funding commitment. So that's just something to be mindful of. And that goes into the consulting I do up front. Now, finally, I'll wrap up here with the next two slides. We talked about qualified retirement plans. Non-qualified plans, I do those as well. Those are not subject to any of the limits I described, any of the limits Rita described. They're not subject to any testing requirements. They are non-qualified, meaning they don't have to follow any rules. There's a little bit of administrative requirements, but there's no limits on how much an employee or an employer can contribute. There's no filings year to year. The biggest downside with a non-qualified plan is if the business goes under, those assets are company assets and subject to creditors. So if you're participating in a non-qualified plan and you're contributing yourself as an employee, you can lose that money. in theory. I've never seen that happen in 15 years. And that's the big difference between the qualified and the non-qualified. Non-qualified assets are company assets and therefore subject to creditor. And finally, I want to wrap up with tax credits. You heard me say earlier, the government's making it easier for employees to get into retirement plans. We're trying to help, you know, we're trying to help this nation have a dignified retirement at the end of the day. And what the government's doing is making it easier for small business owners to sponsor these types of plans by offering tax credits. Okay. So with Secure 2.0, if you've never sponsored a retirement plan, if you have employees, you can get up to $5,500 a year credit, not a deduction, a tax credit for each of the first 3 years. So if you have 20 employees, you can get up to 5,500 for year one tax credit, year two, and year three. Okay. There's credits for employer contributions. Those are phased out over 5 years. So again, there's deductions, there's tax credits. The government is trying to make it as easy as possible for you to save for your own retirement and for your employees, if you have them, to also get into a retirement. And with that, I will turn it over here to Rita to kind of wrap things up for the next 10 minutes or so.
Absolutely, but we want to learn, we want to make sure we allow time for Q&A. So I would say the biggest takeaways are first, think about what you want to accomplish and what retirement you envision for yourself. The second thing is make sure that you're taking advantage of all the programs that are available to you. And third, I would say that this is the most important. It is never too early to start, and it's never too late to start. So now we're going to allow time for Q&A. And while we're allowing time for Q&A, this is like, I just wanted to make you all aware. I partner with people like John to make sure that the plans are compliant. A lot of people's tax advisors may not be aware of all these tax credits. Remember, I know we're towards the end of 2025. If you have set up a plan and you weren't aware of these credits, my goodness, you can't even prepare your 2025 tax returns. You get all these other forms. So just please keep that top of mind.
I think there was a question I see in the chat about the Cal Savers program. Definitely familiar with Cal Savers. That is a requirement. There's a few exceptions to that requirement in California, but that is a state. So for that individual who is from California, I'm actually from California myself. You absolutely need to open a plan. I'm sure you've been receiving mail from the state of California. You can either open your own 401k plan, or you can adopt the state-run Cal Savers program, which operates more or less like a Roth IRA. There's going to be limited investment options, but if you are receiving mail from the state, they are wanting you to either open your own 401k profit sharing plan or 401k plan, which we could certainly help you with, or you could choose to go into the state-run program, which again operates more like a Roth IRA. What I will say is, given the time of year, December 18th, it's going to be challenging for anyone to get a plan created by 12/31. Certainly, there won't be an opportunity for deferrals, because one thing with a 401k, employee deferrals need to be contributed during the year. And there's steps that need to be taken prior to those deposits coming in. First and foremost, you need to have a legal plan document before deferrals come in. The good news is you can establish a plan for 2025 in 2026 by your tax filing deadline. So would be happy to talk to you about that, separate of this conversation here today. What I would say for that individual is definitely do not ignore the mail from the state. Either adopt their program or talk to someone like me about creating a 401k for your employees.
So we have a question. How should business owners think about balancing short-term cash flow needs with long-term retirement savings, especially when income is irregular? I love this question, and here's what I will tell you. And of course, we want John to have the opportunity to weigh in. You might have heard that cash is king. I'm going to challenge that. I actually feel that cash flow is king. So that's not only is cash king, but cash flow is king. So what I would say for those business owners with irregular cash flow, you know, when it's feast or famine, make sure that you're saving the cash from the feast in like a high yield savings account for the leaner times. And then you'll have that money available throughout the year. And then, when appropriate, when it comes time to fund your retirement plan, you'll have that money available and you won't have to scramble.
Yeah, I would agree with Rita. I think it's super important to have an emergency account, a buffer account. You can call it several different things, but having those reserves in the event that you need them, that is super important to have that reserve on hand, and then consider, the retirement account. I think we have one around common mistakes we see business owners making when selecting or managing a retirement plan. I can kind of jump in there. So, to me, it's all about plan design. You heard me say consulting, consulting, consulting. My firm here at Sentinel, I work again closely with advisors just like Rita. And what we do up front is heavy plan design consulting. We don't just set you up with a 401k plan and say, here you go. If you're working with a firm, not to pick on anyone, like a payroll company, like an ADP or a Paychex, they're great payroll companies. They can set you up with a 401k plan. It may be pretty bare bones. It may just be very vanilla. What we do is we take the time to understand our business owners, the goals and objectives of the organization, and we really craft or design a retirement plan that is in their best interest. We get pretty granular. So I would say for those, one of the most common mistakes that I see is not taking the time to really understand what you're getting yourself into.
I definitely would agree with that. And just to expand upon that, all too often people are like, oh my God, I heard that presentation and that's it. For 2026, I need to set up a retirement plan for my employees. That's great. You are doing an awesome job. But I think it's important to spend a little bit more time on the plan design to determine what is most appropriate for your needs.
Any, any more questions out there? If not, I think we have a poll, Rita. There are no
Yeah.
more questions.
Yes. So if there's no more questions, at least not right now, you can always reach out to us. We will like launch some polls. And I do know that this is a lot of information, and it might take time to digest it, but feel free to reach out to either one of us. There's our contact information. We are both very passionate about this topic to help business owners, entrepreneurs optimize their taxes and save money for retirement, build wealth outside of their businesses. So here are the polling questions in comparison to before the start of the session. How's your understanding of financial management improved? And this feedback is really helpful because this is how we improve and are delivering content, preparing and delivering content that's relevant to your needs. Comparison to before the start of section, do you feel more confident in your ability to manage your business finances? And then last, but certainly not least, comparison to before the start of the program, how do you feel about the different financial products? So we value your feedback. And you have our contact information this recording. If there's any questions you have, like I'm happy to take the time to talk more specifically about your unique situation. And we hope that you're feeling a little bit more confident about what options are available to you so that you can plan to build wealth outside of your retirement and save taxes and do right by yourself and your employees. Thank you so much for tuning in with us today. And now I'm going to turn it over to my friends at US Pack to see if there's anything that they would like to either add in the chats or if they want to like share the results of um, anything.
Thank you so much for the session, Rita and John. Thank you all for joining today. Um, Thank you for the time to spend with us in this lovely afternoon. Stay tuned to our next Business Express session and see you next time.